Do you believe that the U.S. is headed into another Great Depression?
I don't think it's going to be a Great Depression, but I believe that we are heading into a very, very severe recession. There will be the normal deflationary bust, as we also saw it in 2008, and it will be a more prolonged recession where we're going to see also a stagflationary development over some time. Feeling this bad is actually just a sign, an indication of what's to come and how bad it can be felt. I've been calling it the worst thing we have seen since 1929. I think we'll be looking at a situation where, like in 2007, the recession started out in December 2007. Nobody really understood that. And Bernanke was out and saying, oh, we will be ready if anything happens. That was in February of 2008. We were like 3 months into it. And he was like, I'm ready. And then they were already way too late. And I think that's what we're going to see again. They say they'll be, oh, we are so ready for this when it happens. But they are actually right now generating or setting us up for that big crash because they are way too hawkish at this point. So I think it'll be scary and painful.
What makes you think that we won't see another Great Depression? What would be the difference?
Yeah, but you're right.
Henrik Zeberg, welcome back to the show.
Thank you for having me on today.
You're the head macro economist at Swiss Block, and I'm sure you've been very busy lately. Last time that we had spoken, you were on the show, we were talking about trouble ahead for the U.S. economy, and I want to dive in. There's a lot to talk about, a lot to unpack, as well as talk about the U.S. housing market, your thoughts on that. But before we get started, just kind of tell everybody, what is the head of being the macro economist at Swiss Block? I mean, what do you focus on every day, and really at how much of the U.S. economy is part of your daily research?
So what I do is that first of all, I'm helping out with the macro outlook for the fund itself. So how we allocate the money of the fund, and also helping our clients. So we have a range of clients, both from the U.S. from around the world, that I help out to understand how the business cycles are going, where the macro view is going, how the macro economy is going. So that's pretty much what I do in order for them also to then make decisions in line with that in terms of their portfolio. So that's what I do, and the U.S. economy is very much what is in focus for me because the U.S. is still where things are happening. It's when the U.S. is catching a cold, the rest of us, are getting really sick, and so it's about understanding what happens in the U.S. before we turn to the rest of the world.
We've been in an everything bubble here in the U.S., right? So the stock market's at all-time high. Home prices are at all-time highs. The most unaffordable I think they've been since dating back to the 70s, and consumer debt is really also at all-time highs. I know a lot of people are concerned with their debt, their credit card debt, their car loans, now their student loans, their housing costs. And big businesses here in the U.S. are cutting back and closing their doors. Do you believe that the U.S. is headed into another Great Depression?
I would think we're not heading in, or the U.S. is heading in, because when I say if the U.S. is, then with the rest of the world will do the same. I don't think it's going to be a Great Depression like in the same kind of manner we saw in the 30s, if that's what people will believe or will think. But I believe that we are heading into a very, very severe recession. And I think we're heading into something which will be a recession where there will be the normal deflationary bust, which we always see, as we also saw it in 2008. But there will also be and it will be a more prolonged recession where we're going to see also a stagflationary development over some time. So I think we are heading into something that lasts longer. And the reason is really that we have, when I say we, the central banks of the world, the Fed, have been using the free lunch that was there. They printed money in a deflationary environment, which did not create inflation. Then they stepped over that or overstepped it by infusing the amount of money they did into the COVID situation. And then by that, actually doing what I think was an inverse Volcker moment, creating a new inflationary regime. So why then, would you probably ask, am I then saying a deflationary bust? Well, because even in inflationary regimes, you can have a deflationary bust. You can see the thing starting to collapse. But that means in the longer time frame that inflation is probably on its way up now, and we have very, very clear examples of that. Which means that the free lunch that we've seen that they've taken advantage of is this by printing money, expanding balance sheet, trying to stimulate with the monetary easing, monetary stimulus, is going to not have the same kind of effect, and actually can have an adverse effect in the situation or in that environment that we are heading into. So I think we're going to see a completely different way of that need to start handling the crisis. And I'm not sure that is not something that will dawn on the day one. Which if they then start to do that again, if you see the slowdown that you're speaking of, and I completely agree with, and I could probably also add to some of these things. You start to look at transportation industries, you'll actually see also that transportation index is starting to break down and hasn't made a new high since 21. You'll see a lot of the indicators. I work with a very brilliant analyst also who does a lot within transportation, and he also sees that we're seeing a clear signs of slowdown in transportation, and that is really a leading indicator on the economy. So I think we are seeing that slowdown, which will then lead to a response at some point. We saw Chairman Powell coming out talking about uncertainties. I think he mentioned it 15, 16 times. And after having been so sure just a few months ago how strong the economy was. So I think the whole balance side of the economy, the housing market, as you correctly mentioned as well, is what is deteriorating again. There's no activity there whatsoever. And I think the only thing standing right now is the labor market. And that is even starting to see we're starting to see the challenge of job cuts moving up. So I think we're heading into it, and I think we're heading into something where they will try to utilize the same tools that they've done before, and it'll backfire on them. And that's why it's going to be a prolonged period of crisis.
Do you think we'll see something worse than 2008?
Yeah, I mean, we can look at the numbers. I mean, if you look at the size of the bubble, then the size of the bubble in terms of the good old Warren the Buffett indicator, market capitalization to GDP, it was at 107.9 around 2007. It's currently around maybe it's dropped a little since I checked the last time because of the decline we have seen, but around 200%, and it was up at 205% or something like that. And if we look to PE ratio for the S&P 500, we are clearly above the levels that we saw also both in 2007, 2000, and into the financial crisis, and also what we saw into the year 2000 with the .com and 1929. So we have these indications on a large level. And then if you start to go into the economy and you look at the different markets, you can look at various places where you say, well, the housing market also looks like it has an oversupply now of housing, and the commercial real estate the same. And if you look to the whole, people say, but you don't have the speculation you have there. No, well, it's because it's moved on. It's moved on to other areas. So now we have speculation in crypto, which is a place where we have a lot of money and a lot of people engaging in trying to figure out whether Filecoin is better than the other token or coin that you have. So there is a clear evidence of speculation. It has taken a tumble here now over the last few weeks since December, but I think we're not at the end of that, and I think that when we get to the end of it, again we'll see more of that speculation, because I think we're not there yet. So when I'm saying the slowdown can happen, it's happening. Well, it's not the same as we're going to see a recession and a bear market starting out right away.
One of the things that, being a real estate broker and communicating with brokers all over the country and watching the trend of home prices and the explosion of inventory nationwide, things sitting on the market for much longer, price declines, I've always said the only thing that's really kind of like the last straw, the last thread, are jobs. We've had historically low unemployment, even though they've skewed those numbers by overstating, almost 900,000 jobs in 2024, and the government being the primary provider of these jobs that we were seeing. Now there's a lot of transition going on. You have Doge, the new administration is going in and cutting a lot of jobs, and we're really starting to see unemployment tick up, as well as, like I had mentioned earlier, these big companies, small companies especially, but big companies that we would think should be financially secure, even looking at their stocks, their prices. But we're starting to see where they're closing doors, laying people off, white collar jobs, high dollar jobs. Do you think, and I guess my question is, if we're looking potentially at something that will be moving in the more of the, I'm going to say collapse, because the financial collapse in that direction, because we've really been in a recession. We sort of renamed what a recession is, two negative quarters, GDP growth, two negative quarters. That sort of was erased now, but we've never seen anything like this. We're not in a recession. Jobs are strong. So we've kind of redefined what a recession is, but all the while debt has been climbing, and most consumers are living off of this debt more than ever before. And now with Powell holding, higher for longer on the Fed rate, and of course that affecting short-term debt, keeping that, interest rate much higher, making it impossible for people to pay off their bills. What do you think will be the catalyst that, finally gets us there? So we know the economy is not doing well. We know the administration adopted this. This has been happening over years and years and years, even before the Biden administration. What will get us to that point to where everyone will say this is bad?
So, like, I don't think it'll be a catalyst that comes before the recession. I think the recession will create what we then will see as a catalyst. Because as we saw from the financial crisis, also it's a big ship turning. The economy is a big ship. It's a big supertanker. When it starts to turn, there will be, it'll take a time before we can actually say, okay, now we're heading in the other direction. And I think that what you're talking about here is absolutely correct. We have been living, above the means, so to speak. We have seen, how debt has been taken on, and we have been thinking that if you just take more debt on, and then, and just having the rates lower, then you can actually, see people start to spend, and you'll have a positive kind of, feedback into the economy and the Keynesian thinking. We've seen that actually what I think we're seeing here is the question that Keynes actually kind of avoided to answer, which was, what will happen at the end of this when you have, you stimulated the shit out of it. Sorry, my French here. The economy. What happens then? And he says, well, in the long run, we're all dead. And I think we're actually, especially if you look to a place like Japan, you're actually getting to that point which he avoided to answer, because you can actually get to the point where you've tried it all. You moved, you did it all. You did all the stimulus you could. You built the debt. That there is just one thing left, and that is really to get it all, resolved in a way. And I unfortunately think that's where we are. I think where we are at the levels where the valuation levels are just, insane. And we have the speculation, and it's not like it's simply not a normal situation if you just go, back to normal times before we started to print money or expand the balance sheet or whatever we will call it after 2008. So I don't, but still, I don't think it'll be a trigger like that. I think what we're seeing is that slow turn, like the frog sitting in the hot water and not realizing really that it's getting warmer, until it's getting cooked. And I think that is what we can see here as well. So the economy will be heading into a recession, and that recession will start off with us even actually know it. And I don't think the recession is here now, but that we have feeling this bad is actually just a sign, an indication of what's to come and how bad it can be felt. I've been calling it the worst thing we have seen since 1929, and I think not saying it'll be worse than the recession, the depression in the 30s, but in terms of extent of the bear market, and also the size of the recession, the pullback, simply because it's based on stimulus. So I think there will be a slow turn. All of a sudden, you will find yourself that you're sitting in that boiling water. We all will be. The moment that we can be looking for is when the short-term yields are plummeting. When we start to see they come down, very fast, which we haven't seen yet. And we have to remember, even though the Fed, they would like to think that they are, completely in control of that, the market has its idea as well also. So when we see 1 month, 2 months and 2 years yields are starting to decline fast, you probably see that the Fed will follow along very soon after. And when that happens, then I think you're at the moment of the recession. And also when you see initial claims starting to move up. Again, this Thursday, yesterday, we saw a low number of 223,000. Not something to write back home about. But as Powell also noted in his presser, that people don't get laid off just yet, but they seem to find it difficult to find a job if they get laid off, and because there you can see the continuing claims are staying high and actually could even be rising. So I think we'll be looking at a situation where, like in 2007, the recession started out in December 2007. Nobody really understood that, and Bernanke was out and saying, "Oh, we will be ready if anything happens." That was in February of 2008. We were like 3 months into it, and he was like, "I'm ready." And
Right.
then they were already way too late. It was past the point. And I think that's what we're going to see again. They say they'll be, oh, we are so ready for this when it happens, but they are actually right now generating or setting us up for that big crash because they are way too hawkish at this point. I mean, fantastic question by one of the reporters in the press the other day, saying, "What is it that the consumers do not understand, Mr. Powell, so that you think it's such a great economy, but the consumer seems to think otherwise because the consumer sentiment is just plummeting? What is it? Where's the difference there? What is it?" And he was like, "Yeah, blah blah blah. I don't even know what he was saying. It's something like the inflation that the consumer may not understand that inflation will be coming down, or it's been hitting them hard, or something like that." Instead of saying, "Well, maybe there is something we don't understand, or we don't focus on the right things here." If you look at the credit card delinquencies and you look at also the mortgage loan delinquencies now, you started to see actually that kind of slowdown that he does not want, and that is happening. So moving into it slowly, like in 2007 and 8, you will see all of a sudden that you're starting to see the black swan events occurring, like Bear Stearns in March of 2008, and then they jumped in and said, save the day there, right? And then we pushed it out to September 2008, and then there was something bigger, which they didn't want to save. I think we should be looking for something similar. A recession starting off, when yields decline, claims coming up fast. They will try to say, well, we will stimulate some more. They may even do some emergency cuts, obviously. And then we will see the recession coming later with some of the great black swans. And there will be a black swan. I don't know if it's on a nationwide level or it's going to be a large financial institution, but I do see a financial crisis version 2 unfolding.
You talk about the press conference with Powell. I think what he was really meaning to say with that question is, I'm rich and I don't know. I'm not affected by this. So,
No, no, no,
I think
exactly. No,
they're
is
just
there a
very
problem?
right.
Yeah,
They're just very
yeah,
out of touch, right? And I guess I
yeah,
would also go along with that. And all of my buddies are rich too, and so we have these stopgaps and bailouts for the banks and central bank. I mean, they're a board of bankers, so and the Federal Reserve. The other thing that you were saying, and sort of with a chain of reaction, is almost so. What I'm getting at, or what I think that you're getting at here, is that we're going to be trotting along. That we're going to start to see where middle class is even more affected. Probably will be going out less, spending money at restaurants, starting to pull it in a little bit, and then all of a sudden we'll see like a big announcement because they're not saying anything now, because it's almost like a self-fulfilled prophecy. If they come out and say, "Oh, our business is in terrible shape," "Oh, stockholders, shareholders, we're really struggling," until these earnings reports come out and you start seeing where the cutbacks haven't worked, or the cutbacks had more of an impact than desired, or that didn't help them financially. Then all of a sudden the big announcement like the Bear Stearns. And then all of a sudden, other businesses say, "Well, me too. Well, we're in the same spot. Now that you said it, I can say it." And then boom, boom, boom becomes the chain reaction.
yeah.
What do you think would stop if we go back and look at history? I mean, we came off the Roaring '20s. You could say the same thing over the last decade, right? It's been nothing but uphill, growth and profits and baby boomers and Gen Xers making more money. the crypto billionaires happening. All of these things we've never seen happen before. The biggest bubbles in history. Yet most Americans, the middle class and the lower middle class, are struggling to make ends meet. People can't buy houses. They went to college. I mean, if you go back in the 20s and as we go into the 30s, really just say post World War II, we're so much smarter in theory than we were back then. So we're more educated, more in debt. We now have two incomes in order to have a home. Mom stayed at home back then, raised the kids. Everybody survived on one paycheck. Then all of a sudden we had, the stock market collapse, threw us into, record unemployment. And now we're at soup kitchen lines and, talking about the Great Depression. Henrik, why don't you think that with things being in a lot of ways so much more fragile financially, shy of them coming up with universal income and bailing everybody out, when the shit hits the fan, what makes you think that we won't see another Great Depression? I hope you're enjoying the interview so far. I just wanted to take a brief moment and let you know that this podcast is brought to you by SachsRealty.com. Here at Sachs Realty, we're committed to bringing you the best real estate education and helping buyers and sellers achieve their real estate goals. If you haven't subscribed to our channel, please consider doing so now. And don't forget, we're on every major social media platform, so you can follow us there as well. Now back to the show. What makes you think that we won't see another Great Depression? What would be the difference?
Yeah, but you're right. And I can say I've just been the most bearish person normally in the room that I'm sitting with when it looks at this perspective. So I like your question, because I think that it's like people are thinking we have adopted or developed these new tools to understand the economy, and we are, as you said, wiser, or at least we think we are wiser. But by the end of it, it's in within the fear and greed kind of thing. You see that we become over optimistic, we become over pessimistic on things, and right now we have had a decade here, or more decades, where we have seen that, as you said, we have been living over the means, and why wouldn't we see a large mean reversal here? Just if you just look at that, well, I think that is what we're going to see. And you can say it, even if the stock market now were at half the value, we would still be at the level that we saw in 2007 and 1929, also in terms of market capitalization. So I hope that we do not do this, that we will not see the same mistakes that we saw into the depression. And I hope that they will understand that there will need to be structural changes to things, because if you get a stagflationary development, that I think they will. So just very quick here, I think we're going to see deflation unfold. I think the Fed will come back in again, and that's normally what people will say to me. But Henrik, you don't understand. The Fed knows that they will come in. They will, fire the big money bazooka once more, and I'll say yes, exactly. That's the problem, because when they do that, and you are in a new inflationary regime, that will backfire, and that will backfire big time. So I can only say that why we will not see a Great Depression, because I hope that we will see them come, gather the strength and gather the the society and everything to do what's right. And the first thing that we need to do is to again ensure that we got sound money. I mean, this will be about a monetary reset. It will be about in saying, okay, we cannot use the currency like what we have done over the last few decades here. We cannot weaponize it. We cannot we need to make sure we cannot just print out but that will take some pain before they get there. And I'm not sure that the politicians will understand this. I'm pretty sure that the Powell doesn't understand it. It will probably be something that requires a lot of pain before somebody sits down and say, well, you know what? Maybe it's because we actually paying, and we get the hangovers now from what we have been, the party we have had by printing a lot of money for the last 20 years. Maybe that's the case. But until they do, and until they start to do something about, and if they do, if they get to the moment where they can do the structural things, well, then it'll be debt forgiveness, it'll be restructuring, it'll be introduction of a new, world currency, maybe something, all these things, which I think is needed. There really needs to be a cleanse out of the system, which if they take a long time to understand that, then it can become very bad. The situation can become bad, and I just, maybe it's my hope that's saying that it'll probably not be as bad as the depression.
I grew up with my grandparents, and my parents split up. My mom moved back home when I was a baby, and they were products of the Great Depression. And my grandfather, he was an older guy. He had retired from a company called Martin Marietta, which is now known as Lockheed Martin. But he went back to work and for the Department of Education in order to be able to afford to have a baby in the house. And as an old retired guy. But it was amazing to see what the effects of the Great Depression had on them and how we lived and how we saved and how we made do with what we had. But it took that was a very painful time in order to get back to sort of have a generation in check, a generation that knows how to survive and be happy and actually have a great family, knitting and just it was an amazing opportunity for me amongst, a lot of people say, well, your parents split up, you miss out on a lot. I was blessed with having such great grandparents and a great mom. Mm-hmm. But I guess what I'm getting at here is we don't really learn anything by debt forgiveness in America. I've watched what happens in the in the housing industry where the loan officers creatively find ways to get buyers money because they don't have any, because they never saved anything. A lot of it's their own fault. Why would you buy a house with no money? I mean, do you think that everybody deserve to own a home? No, not if you don't save and you don't do the right things. I'm sorry. I don't believe in forgiveness, the debt forgiveness, okay? So what happens, I don't believe in the bailouts. I don't believe in forgiving them of their student debt. Now, yeah, we may not have served them well by building a system that pressured them into making decisions at 17 years old on $200,000 in student debt. Yeah, they were hopeful and sold a bill of goods, but that doesn't mean that we just make it wipe away. It's not teaching people a lesson of, what people went through in a Great Depression and learned by it for generations and had generational impact. So I think the government has been under this, this pathway of we can have whatever we want if we kind of give them whatever they want. We just kind of keep them happy. We just give them enough bailouts. Their equity stripped and taxation and all that stuff. But if we could just get what we want and give them what they think they need or want, then we'll just, continue right along. Well, obviously, like you said, the result of all of that has been that nobody can afford anything. We print in 2 years more money than we do in 200 years. We give people everything. We prevent their mortgages from going to foreclosure. We pad their bank accounts for a period of time. We overpay them more than what they made when they were working to be on unemployment. We prevented them from paying their landlords as tenants. We said, no, don't pay them. This is craziness, man. And now all of a sudden, after all of that, we're in worse shape than we've ever been. Now, you could sit there and say, well, there's a lot of money that people are as wealthier now than they've ever been. Only certain people have taken advantage of the stock bubble. Only certain people have taken advantage of hundreds of thousands of dollars in equity in their homes. But what we did in the process of that is we've robbed the future of our, kids and grandkids of being able to achieve these things because we've made it unrealistic. So I guess, with that being said, that was kind of like a rant, but I guess it's just a world that I'm living in right now.
Oh,
right?
really? But I agree.
So what do you think about, a lot of people there, and I don't really understand it because, I think that regardless of who the administration is, if we can find where we can run more efficiently and bring taxation down on the American population, let them keep more of their income that they're making, do better at financial literacy, educating people in financial literacy. Let's talk about what Trump is doing. What is your opinion on the tariffs? We make very little here in the United States. Do you think that manufacturing should be reshored? Do you think the tariffs will work? What will be the short-term pain and the long-term gain, if any? What's your thoughts?
So I think we have been one of the things that you also mentioned here with that for some time that we have been living in a world where we have been trying to artificially support people. I completely agree with that 100%. And I think there is another element to it also, where we've been living in a globalized world, which has many good benefits of it, if it was based on a situation where the countries that we are trading with are actually living under a want to have the same kind of future setup like we want. I mean, I'm saying we because I think here in Denmark we want the same like we want in the U.S. But I'm not sure that there are some of the nations out there that want exactly the same like what we want in Denmark and the U.S. And I think with that, when you just without any thought, actually just more or less just give over your technology to some to countries like that in the good interest of trade, that is not a good thing. I mean, obviously, then you will start to push the advantage into the hands of these nations, right? That is not a good thing. And so there will be it's a good idea to make sure that that you shore up the technologies that are so important for long term development of the country and for and not giving that away. That is important. When it comes to the trade part, and I mean when it trades between partners that are really truly allies, also like Denmark and the U.S., for instance, right? I mean, where we have no incentive of going against the U.S. At any point. I mean, we're trying to support it at any point we can. I think there then it's probably not so beneficial to have the tariffs, because the only thing it will prevent us from trading with the U.S. Europe as such also. And I have friends that have businesses that are working and trading with in the U.S. as well, and they are now sitting and holding back on some of those investments. So I think that kind of when you put tariffs on that kind of thing, then it will prevent trade that is good, that is beneficial, and especially for the U.S. when you have an economy where you have a strong dollar and you can go and you can actually buy the cheap stuff here with us, even though we're not trying to cut wages. I can tell you the wages in Denmark are quite high, but we're still managing to sell and export to the U.S. Then it's not about unfair competition, but it's about competition, which is fair and good and strong. And it should be like that. Everybody's strength, gets stronger from competition like that. So I think in that context, tariffs are not a good. It's not a good thing, because that will weaken trade in the world, and that will actually make us weaker, us poor, and it'll make the U.S. poor, as I see it. And I'm not sure it's gonna make up for it, as you can see when you had it into the depression also, when Hoover did something like that. 20,000 goods or products were tariffs back then. You saw that you had actually lower revenues going into 5 years later for the U.S. federal administration. So a tariff will not work with that. But when it comes to shoring up, as I said, technology and making sure you don't do a dumb thing, simply just here my maybe future enemy, my technology, take that, use it. That's a bad thing, obviously. So I don't think it's for trading and for the economy. It's not a good thing to do it with allies and people and nations that you can trust, because it'll prevent growth. But in the other perspective, I can understand it.
But if you were here in the U.S. and would you want to see a nation that wasn't so dependent on getting their products from overseas?
I think I have not. I'm not living in the U.S. I think it will be more in a more expensive world by the end of the days, because there will be things that can be better and more efficiently produced elsewhere. And if you give any country and say you have 100, of production units, and you want to focus on something that you're really good at, then theoretically you should have a higher value in like the U.S., for instance, having high technical capabilities in trading these things with us, Canada, whoever. But if and then the other way around, that we should then supply whatever we can. So I think there is a good thing of having a good home production, and this about giving your all the manufacturing away is not a good thing. But there is a fine balance there, because you can also be utilizing a lot of resources on producing things that you can easily buy elsewhere and will not create as much value internally in the US as it would by acquiring it. But it's a fine balance, and there is nothing that is good, black or white here, as I see it. So the tariff, if they are going to take effect and have the right effect, well, then they need to be introduced in the right, to the right countries, on the right industries, on the right products. If it's done more broadly, then I fear it can have a very negative effect on growth, like what we have seen before.
Yeah. I think about, and I hear what you're saying. And look, I know that, for quite some time, it seemed to work really well to have a connected, global economy. And, but I think what from my perspective as a small business, I look at, we're a nation of capitalism, and should be, that should be good for competition, right? But the problem is that we've watched these big companies through the decades become, through lobbying and through, uh, putting people, running for offices, that if they get in, seem to be able to do some favors to help them become even bigger and you see this in the stock market, right? I mean, you're in that world. But what I think happened along the way was, and I think one of the reasons why we're in the position that we're in, is because, you can look at it and say, okay, well, manufacturing is, cheaper overseas, and that may be so. But the problem is the American people don't always see that savings, because it's hidden behind, outrageous CEO salary. I mean, I'm talking, when you see CEOs making 300 million a year, and like crazy money, right? Not saying
Yeah.
that people shouldn't make money for being successful, but when they're actually preventing competition instead of encouraging competition. And I can go one step further and say, I can remember when we took an offshore customer service. These big corporations, so call centers are now overseas. We've eliminated so many jobs, and they may not be the highest paying jobs, but they were good jobs, right? They were jobs that had benefits. They're jobs that, people could live on. And I just see where, like, I can see where, if there was a reshoring in the US, and maybe these tariffs would do that and say, look, you have to operate here in the US. You have to build your manufacturing. You have to bring your call centers back. You have to do these things. I guess I'm just fearing for future generations that there will not be a United States of America if we don't have some kind of opportunity here, because our inflation, even if we're looking at 50% cuts in housing, it's still, that's only taken us back 3-4 years in pricing. Wage growth
Yeah.
has not kept up. Wage growth
Yeah.
hasn't been there.
No, you're right. I mean, again, we need to have internal, production, manufacturing. Also, that goes without saying. And the only balance need to be strike is that you have to still, there will be things that can be relatively cheaper to buy abroad and will be helping also the consumer, because the backside of this can be that even if you then do produce it here in the US, well, then it will be at a higher cost for the consumer. So there has been this feeling of wealth, because you can go buy it elsewhere for the consumer, which then will be some sort of taken away again, because you then have to produce it maybe with higher wages in the US. So that's the trade-off there, and that's where the it will be that, at least, as also you can see from the press on Wednesday with Powell, that there could be some element of inflation coming in if the tariffs are put up, because they will, or when they are, because they will simply make it impossible to import these cheaper goods, and that is something that the consumer will be feeling. So I completely understand. That's why it's not an easy thing. It's a thing that has many facets to it, and you need to strike the right balance. And I'm probably not the right one to say how it's done in the U.S., but
We
but agreed. Home production is absolutely important. People need to be able to work. There needs to be a job for everybody with a good paying job. And I'm not. I mean, I also, when I just here in Denmark see the salaries that some of the CEOs have here, I also have to say, well, is it really because of that one person, or is it because of the 10 next, or the 100 next, or the 1,000 next in that organization that is actually doing a great job?
it's funny because just talking about this makes me think about the regulations that we have here in the U.S. And you say, well, manufacturing would be more expensive in the U.S. Well, most of that is because of the amount of regulations that we have here. We care less about the regulations of other countries that are producing the goods. Like, what, we're on the same globe. I mean, if you want to sit there and say, hey, we want to be, um, green conscious, we want to make sure that we are taking care of Mother Earth. Then we have to remember that they're not adhering to the same regulations that we are, that we're buying these products. Of course they're buying it, making it for less, right? Regulation has a lot to do with it. Let's talk about the stock market. Go ahead. I'm sorry. Did you have something you wanted to add to that?
No, I completely agree. I mean, it needs to be under on the same set of rules, and they need to be followed also, because if you have countries that do not follow that, and then you use cheap labor also and things like that,
Exactly.
that's not what we wanted to have. And that's what I'm saying. That is not a situation that we have here, for instance, with Denmark or in Europe. We do not, we actually do follow that, and I think even Europe is more rigorous when it comes to these kind of legislations, when it comes to environmental protection, all that, in the US. So I think, I think it's something that it's a balance that needs to be found, and I think it's we'll see what the next few months and years here we'll find out.
You had said, well, we were talking about the stock market, and you used insane, which is exactly what the word I was going to say with the stock market. It seems very volatile, very frantic, very fragile, all based on consumer confidence. We saw a week ago big sell-offs, 10% correction. Things have been sort of sliding. You had mentioned Bitcoin. That's down. I mean, I've a chart here. We can just pop up here right now. It's at 83,704. I mean, it had gone up to, a peak when Trump was, over 100,000 when Trump was elected. In fact, he said to all of his, I think crypto was like his biggest supporters were, these crypto billionaires. And then there was a huge sell-off, right? So everybody thought, well, the government's going to get behind cryptocurrency and, Bitcoin, and all of a sudden it's going to go to the moon, right? So everybody's like, yay, obviously it's sliding. But what do you think is going to happen to the stock market? Is it as fragile as one may or should expect?
Well, I think we are in a situation where we're heading into the final innings in the stock market before we actually see that big top, and there are many reasons why. First of all, I don't think the economy is quite weak enough for us to see a big decline in the stock market. Second of all, the sequencing of things does not seem to add up at this point. So just last week, last week, we had a new all-time high in the German market, in the DAX. You have had it also. You see that the emerging market is actually moving higher. You see Hang Seng, the Chinese market, and it would be not really sound right to me that you see that the U.S., which is the center of the world when it comes to the financial, to everything around finance, well, then that we'll see that the U.S. should be the last, should actually be the first domino to fall compared to let's say to the DAX. That's kind of reverse to me. Also, technically, it seems like this is a correction that make people come and think now the big thing is going. Now we're actually in trouble, and we'll be pointing fingers at all the things that comes out of the White House and saying this is the things that right now is driving this. And I think you're going to see actually that the market is going to climb that wall of worry, and you'll see that you have an actually rather strong rally coming very soon. I think chances are we are either have seen the bottom of this decline, or we're going to see it very soon, and we'll see a very strong move higher. I don't think this is the big one. I think we're going to see another move up higher, because if it was the big one, and you look at the Nasdaq actually topped in December, it just does not add up, because that would have meant, sorry, that we should have seen a recession setting in very soon. A recession would have meant that we should have seen yields coming down soon. We should have seen the initial claims coming up. We do not see that, and there are other things also we could look for. So I think maybe people are front running things a little here again and thinking, well, now the big thing and all this is actually already starting. Whereas I now think this is the fear, the run away from the markets, which will make people run back in again, in bigger volumes, right into the top of it, and it'll actually catalyst it, catapult it much higher. My target is now 6,500 to 7,000. I mean 6,800, around that level maybe on the S&P. So I think you can have a quite strong reaction, a counter reaction to what you've seen here, especially because you now also see the Fed is starting to, what we saw Wednesday, say, okay, we actually do pay attention to the unemployment level. There were clear signs of the report also that they sent out that now inflation is kind of moving in the background. Their estimates for the next quarter of inflation was actually lifted a little, and but the expectation on the unemployment was also the GDP level, the real GDP was dropped a little. And that I think they're starting to pay attention to, because what they did with the tapering of the quantitative tightening, that is actually a very dovish move, and I think that is going to support the stock market here until the moment when the real economy catches up. The things you and I talked about before, the real people, the real Americans sitting there and trying to make ends meet, working 2-3 jobs to simply make things, and not to not sell his house, because if he has to, well, it'll be very difficult for him or her to find a new place to live, and all these bad things that we really don't want to see. So I think the Fed will become more and more aware of that. And I again noticed that I think it's 15, 16 time he was talking about uncertainties. And again, also this about they do pay attention to the consumer, but maybe not to the degree where they should have done earlier, as I see it. So they will come more in, and I think that is going to propel the stock market into the final high, which will be a strong move higher, bringing people into the wrong side of the trade, so to speak, of the fence, and then you're going to see the stock market starting really to decline, and that decline is going to be bad. And I think it's going to be late this year, it'll be mid-late this year before we really start to see the effects of that, because the rally can be strong and fast, and it will not end out with a whimper. It will be end out with a big bang. Everybody's euphoric. And I think Trump will come in again. It's like with that also with the president, as the ever sitting president will always be either the hero or the zero, depending on where the stock market goes, right? So if it goes up to those levels, they'll be like, oh, now he's the hero, and then boom, it maybe go the other direction. So I expect a strong rally in the stock market, and then I think you're going to see a top later on, and everybody will be running into that, and then that's the big thing when we see that.
But you think it will go the other way. So you think we're going to have a higher rally, but you're still saying that you think in 25 we're going to see it go down.
Yeah, I think the top will be in 25. Yes, I don't see a much chance of seeing it 26.
So along that same spirit, 1987 to 2006, we had Alan Greenspan. He was the chairman of the Federal Reserve. Back then, he developed a policy to bail out stock investors, preventing Wall Street from collapsing. It was known as the Greenspan put.
Yeah.
Can you sort of explain what that was designed for? And then do you think that we will see a Powell put, or do you think that will no longer work?
So I think they will again, that is the bazooka that I think they will come in with again, because they think there's one thing that they fear the most, and that is deflation. That is the moment where values, fortunes, home values, and so on will start to just, to get into a negative spiral, and people will be selling off and just, not trusting that they can, own a home or own, anything, won't be buying because, things will lose their value, and people will then lose their jobs, in big volumes. And so they will fear that. And the one thing that they know can be very, very um, damaging to economy is that when that happens, then you have all the balance sheets on the banks will start to deteriorate or actually getting destroyed. So that's why they always will come in and try to save the banks. And if by the end of the day, if they had to choose between deflation or inflation, there's no doubt what they will choose. They will choose inflation, because the deflationary default will mean a very strong destruction and fast destruction of the society. Inflation will be starving people slowly over the years. So starving like what we see now already. We've seen that with inflation. So the Fed will rather try. No, they if they let it fall, then they will see that things really unfolding very, very quickly, and then you are in a depression like what we had in the 30s. And I think that is the change here. They will rather pick the other button. They'll press that button instead. But that's why I think they will be coming in, and that's the put. That's the put. It'll be seen as the put. But the thing is, I just don't think it has the effect this time around as it had the last time. And that's probably the difference. So the put that was so cheaply put in by Greenspan, and also by Bernanke back then, will have another different kind of price to it this time around, because simply you will not see that the effect will be as strong, and there will be inflation coming out from it as well.
I've heard you say on a couple of interviews to prepare for deflation, and I think that's sort of what you're getting at. If we start to see a major decline or crash, correction, whatever, in the stock market, that's sort of what got the ball rolling over the next several years for the housing market crash, because we watched people take their money out of the stock market. They didn't know what to do with it, so they put it into housing. We had people buying houses that for investment. We've been seeing that ever since the great global financial crisis. But then that was really like the second whack. So people lost money on the sell-off. They went into the real estate business, investing in real estate, then that crashed. And then really we started seeing that deflation that you're referencing here. And in the U.S., we really have no reverse gear. And, because everything is levered up so much. And, with that, let's talk about the housing market a little bit, because there's some major changes that are going on. I want to pull up an article here, and this is all unraveled Thursday. So we'll start with this article here on govexec.com. Housing agencies begin closing offices, escorting employees out. Two key agencies overseeing the nation's housing policy have begun to eliminate offices and shed staff. The Federal Housing Finance Agency, which oversees Fannie Mae and Freddie Mac, the federally backed mortgage institutions, has so far this week shuttered two of its divisions, resulting in a cut to nearly 10% of its workforce. I'll pull this other article up here on Politico. Top housing regulators in upheaval as executives, employees put on leave. The sudden development add to the upheaval at the independent agency, which regulates Freddie and sister firm Fannie Mae, the government-controlled companies that stand behind about half of the U.S. residential mortgage market. I think it's way more than that. They come as the administration weighs privatizing the giant firms. And it says a decision that could bring a windfall to private investors, but that is opposed by many Democrats and others who fear that it could roil the housing finance market. So when we're talking about, we're kind of, Henrik, what you and I have really been unpacking and talking about is this bubble that has become so big, and now everything that is happening to try and gain back control of what has gone out of control, mostly because the government's showing up to help. I don't think there's ever been a good time where the government says, I'm here to help, and it actually works out. They hit a gnat with a sledgehammer. They overstaff these agencies. They create more debt trying to solve the problems than they would if they actually, solve the problems. And, so here we have, since the GFC and the housing market, they took over in conservatorship. I think it was like in September 6th or something. In 2008, the government took over Fannie and Freddie, right? They were the ones they're backing these loans. We won't use the word insuring like FHA or VA, but we'll say they're backing. They're basically giving the investors the confidence to invest in mortgages because, they're going to be the stopgap, that put, if you will, to prevent the mortgage industry from imploding. So now we have a situation where we have suppressed foreclosures. We'd already be in a 2008 crisis. That would have happened in 22. At least 22, if not maybe even 21, we would have been heading into that where millions of people were probably been foreclosed on. Over 1 million people took advantage of the modifications, the loan modifications. They would be out, right? But because we have the federal government has put these GSEs, government-sponsored enterprises, into conservatorship. They're managing them, regulating them. Fannie Mae, Freddie Mac, they're setting a lot of the policies for qualifying for mortgages, whether people, how they qualify. If we privatize that, what will happen to mortgages? Because as an investor, and the government's no longer backing.
Yeah, not supporting it anymore. Yeah, exactly.
What happens?
That's yeah. What happens then? Yeah, you could say that then there'll be stricter, there'll be restrictions on who will get the loans, and you'll see that the housing market will then have find it even harder, harder times. So I'm not a favor of any support by the government here. Absolutely not. I mean, I think it's not a long term solution at any point. But the thing is that it can become a big problem for the housing market in general, and then hence for the U.S. consumer. So, and that is actually what I fear that's going to happen. That's why when you ask me again, and I'm sitting this question is still in my back of my head. This why will it not be as bad as the Big Depression? I mean, there are many factors here that we're pointing to. You're pointing to here also that can send us in that direction, and especially when it comes to the housing market because it's so big. First of all, it's so big, and everybody who has a mortgage loan, and if things are not, increasing in value, there'll be a lot of problems. But some things like that are developing. Well, then you'll see that the housing market can find it in even bigger problems than it already is. And this is actually one of the things I've said also on X for quite some time that, people may look at their labor market, but it's the housing market really now, just like in 2008, that is starting to show the cracks. It's very, very, clear. And if you look at the number of existing homes sold, that number compared to the population size right now is ridiculously low. So it's just stagnating. Number of mortgage applications is just rock bottom. So as you say, there's nobody can really afford it. So if any policies comes out like what you're suggesting here, well, then you're going to see the housing market cratering even more. And I think that could be leading to bigger challenges, first of all, in the housing market, but the housing market never stands isolated because housing market is also about contractors and, craftsmen and so on, and that needs to work on the house and do, improvements. And if you see that your house is not worth as much or you can't afford it, you're not going to get that, kitchen refurbished or doing any kind of improvements to your homes, and that will then have trickle effects into the economy, very severe trickle effects. So the housing market is so central, and you can just think about our own economy. I mean, my personal economy, I have my house and I have my job, and these two are the things that's the foundation of me. if I lose my job, I need to find one fast. But if I see my house deteriorated value and I can't afford it, plus I lose my job, then I am in deep shit, so to speak, right? And I think that is unfortunately the situation we heading towards. So I think you're making the correct, you have the focus here on the right thing. The housing market is not good, and there are clear signals out there right now that this can actually be what can trigger a big crisis. So when you said this again with the trigger of the things into the recession, I think, again, housing can become a problem just like in 2008. Whatever kind of, black swan we're gonna see, I couldn't guess right now, but there will be something.
When you talk about a debt bailout, earlier you had suggested a debt bailout. I can remember going through, being an agent and actually being a home builder and remodeler, contractor back through the GFC, and watching what was happening. I saw where people who could afford to pay their mortgage, they stopped paying their mortgage because they were like, well, the house across the street's $100,000 selling for $100,000 less. Maybe it's even better than my house, or maybe it's the same as my house. It was built in the same time frame and, the same floor plans. And people are buying the house for $100,000 less than my mortgage that I owe on my mortgage. And there were a lot of people, and people are surprised at this because you don't hear about it. But I watched it firsthand where people actually turn their keys in and stop paying. So I think what would happen is if we start talking about, well, I'm going to bail you out, I'm going to bail your debt out, I'm going to forgive you. If they give people the opportunity to have debt forgiveness, there's going to be a lot more people that take advantage of that than the ones that necessarily need it, right?
Oh yeah, sure. And that would be the case. Absolutely.
They would also have to wipe out the penalty of that. So, they would have to, because if your credit's damaged for 7 years and you can't spend more money, you can't finance, then that hurts the bankers. So they would have to not only cancel the debt, but they would have to clear your credit too, and or sort of like box or mask that happened to you, so that you can keep spending and keep buying and keep reinvesting.
Yeah.
So it's
and that's the big solution that I'm talking about. This is a structural. I mean, I'm not talking about solution because I don't like the sound of that either. As like what I think you also don't. So what I'm saying, the problem is that the free lunch in terms of just reducing interest rates and trying to make them suppress them, I think that time has passed now. And that what I mean by that is that if they then will try to do that again and interest rates then goes up, then they're going to make the problem even worse for these the house owners. And that's where they will stand, between a rock and a hard place and say, well, do we want to do that structural kind of thing that nobody likes? Or do we want to have a complete, demolition of the housing sector and people in it? And I think they'll choose the first one again, and that will be complete and wipe out of a lot of debt and debt forgiveness across. But it will take a lot of pain before they will get there because they do not want to do it, I'm sure, but they'll be forced into it. So the trigger. I don't want to say a word that I don't mean. It will be interesting because I don't think it'll be interesting. I think it'll be scary and painful. But I think it'll be interesting to see what is going to become the trigger of all of this.
They may have to allow the bail-ins at the bank too, if that's the case. I mean, if you think about it, if they're going to forgive the debt, they may just say, "Well, we'll forgive your debt, but any money that you have in the bank is now the bank's." Because they're taking
25% of it. That has seen before. I mean, it was you can see that they will simply close things off for a week and they'll settle things and say, "Well, you thought you had $10,000 standing there, but now you have 7.5. Sorry about that, but that's the way it is."
Yeah. Henrik, obviously, and I mean, look, I'm not receiving any financial benefit having you on the show, to point people in your direction to invest and things like that, though they can, right? I mean, people can reach out to you and I'm sure invest in your company's fund and things like that, right? I'm correct in saying that, right?
Well, it's a more of a family office these days. So, but they are looking into opportunities to actually to broaden that out. So for now, it will be reaching out to me. Yes, I'll be able also to help out with the macro outlook for as I do with our clients. And you can reach out to me on X at Henrik Zeberg, and yeah, and I try to get back to as many as I can when people reach out with serious stuff. Obviously, there's a lot of not so serious
Yeah,
stuff,
right,
but yeah,
right,
serious
right.
stuff. Obviously, always trying to get back to people.
So, what can you say that your advice right now to encourage people? I mean, what are you telling people now that they should be doing in planning for the things that we're talking about, sort of like to protect their money? Because that's a big thing. I have a lot of people that reach out to me and they're like, "Well, what do I do with my money?" I'm like, I have these, um, people finance on the show. One's talking about gold, and others talking about diversifying their portfolios, and I mean investing in bonds. I mean, what are you telling people that they should be doing? What's your advice right now?
First of all, if there was something that was so simple, you say buy this and you'll be fine. Then I think the situation wouldn't be that bad. But the problem is, I don't think there is something that is so easy right now because of the whipsaw that we can see. What do I mean about that? I talked about this blow off top that I think is going to develop because I think the Fed is going to realize the severity of the situation pretty soon, and they will change stance. And we actually saw some signs of that here on Wednesday. So in that phase, you'll probably I mean, it'll be difficult at least to stand out of that. I noticed that Warren Buffett is taking his chips off the table, but I think there'll be a lot of people that will sit and say, why didn't I go long something, equities, NASDAQ, tech stocks, what something in this final phase here? And if Henrik, if you said to me, I shouldn't, why did you say that? So I actually say the problem is here now that you can actually take advantage of that being right, but also being wrong, because you can be wrong in the way that thing you can be, lucky that to get into that top, even though it can be like 20%, 25%. I could easily see that moving higher in tech stocks and in NASDAQ also. Um, but you need to get your chips off the table at the right time. When that deflationary part begins, well, then people saying, well, but it's a crisis, you need gold. Actually, gold and silver, I think, will be fantastic, but not in that phase. Because if we're gonna see like in 2008, we'll have a deflationary illiquid kind of phase, which was from March of 2008 till September of 2008, the 6 months there. You saw silver plummeting by 60%. You saw gold dropping by 36, 35%, something like that. And okay, of course, then when the Fed comes in with the bazookas blazing and thinking, now we're going to give you a new free lunch and we're going to bail everybody out, then I think the time for gold and silver will be here. But then there will be other things that you should not hold. For instance, bonds, which may have an impact, which may have a good rally here going into that deflationary phase. So it will be very, very difficult. I think it's risk on right now. It's equities and whatever, and crypto could also be. I think there could be a good rally in Bitcoin as well. But then it will be about deflationary protection first, getting out of that again also, and then it'll be about stagflationary protection, and then holding on for that for some time. And I think that kind of shift in the investment in a landscape will be so difficult for a lot of people to navigate in, that not only ordinary people but also pension funds and others will lose money in this process.
Hmm. Should people keep cash?
Yeah, cash is also a problem. I mean, again, cash, if you hold cash and you can, first of all, end up in the situation we just said there, where, you have my money on the bank account. And then, yeah, well, will they do a bail-in? Do they need to do that? Will it become so severe? Second of all, if you start to see inflation, well, it's not good to have cash standing. So
Burns it up.
there will, again, there will be, bad sides and the good sides of all, and, a lot of things here. So, but cash will be good to a certain degree. There'll be a certain amount of gold will be good, and there'll be some risk asset maybe, but also at some point simply pulling out of risk and just say, I'm gonna stay put. And for as long as you can pay your bills and you can say look into that kind of situation for the ordinary person, well, then that is a good situation for a lot of people that they can reach that level, and then maybe in a market where everything is just declining, 0% for a few years is actually okay, because then you're treading water while everybody is almost drowning, right? So I think that is it probably here that we have been used to these super up to super returns over many years, and that just cannot persist. And I think that is where maybe settling for less for a little while and understanding that you need to be either able to pay for, go through the crisis and just, sit still, sit tight with what you have got, and then understand that you may lose a little instead of, risking it all and trying to navigate in that very whipsaw kind of environment that I think we could be heading into.
How about home buying? You think home buyers should sit it out, wait?
For many, there will be no other solution than that. I think that is that could be the best solution for a lot of people, actually, to sit it out. And they again, if they when the Fed comes blazing in, over time we will see that the housing market will recover. I think there can be a decline in it, but I think the housing market will recover. I mean, people will again at some point start to build want to buy a new home and move on, and needs to move on. So I think that is something that will happen. But again, it can take a little while before things are going on. So if you're happy, or if you have a good home and you like to live there, well, positioning yourself there for some time and then sitting it out could be a good strategy. Yeah.
Yeah. Henrik Zeberg, great advice. I really appreciate you coming on the show again, and hope to have you back sometime soon, that we can continue this talk as we watch what happens as this thing continues to unfold. So again, all of Henrik's information is on the show notes. You heard him say it. If you're serious about investing and you want some advice, reach out to him, and I'll talk to you soon.
Thank you very much.
Thanks so much for watching. If you like the video, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. Keep those comments and questions coming. And one of the biggest compliments you can do for us all here at Sachs Realty is to share our channel and this video with your family and friends. This will help us to continue to build this amazing online community with viewers just like yourself. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.